Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. I really do. Thank you for all the subscribers. This week up, we are going to look at Verizon, the absolute behemoth in the wireless space. They got a huge dividend. They're paying almost 5% in a yield. Let's figure out, can they afford that dividend? Their debt has tripled in the last decade. Let's figure out how much cash flow they produce and can they afford the dividend. You ready? Let's get to work. All right, we're going to dive into Verizon this week and figure out how much cash money does Verizon make and what are they doing with it. First, I want to remind you to always read the 10K. So I'm going to review the 2021 full year financials that Verizon just released. You should pick up a nice hard copy of the 10K yourself. Do a little reading, get a whiskey, get a coffee, whatever you need. That is always the critical point, is to read that the SEC file document, not the high glossy management presentation, the sales pitch that they try to get you to read. Go read the black and white, get the facts for yourself. On this channel here, we're dedicated to the rational, cash flow hungry investor. You're not going to see any red or green lines here, no flashy lights, no bulls or bears going to dance across this screen. We're going to look just for hard facts and cash flow. And we do that by looking at 5 key attributes for any stock, and I want to review those with you right now. Number 1, top line revenue growth. You got to have it. Number 2, earnings growth. We need to see EBITDA, enterprise level earnings growing. Number 3, we need strong free cash flow. Number 4, low debt. Got to have low debt, less than 3 times debt to EBITDA. And number 5, we want a stock that's well priced. Now, I'm not looking for the cheapest stock, okay? We're not going around picking up cigar butts here. This is not the 1920s. Most everything is very richly valued. What we want is something is this reasonably priced in which we would buy it and hopefully over the next decade get a return that is above the market, above 10%. That's kind of where we define a well-priced stock. All of you have your own internal rates of return that you need on your own capital to get to your financial goals. And so you're going to set that hurdle wherever you need to accomplish your goal, 10, 15, 20%, whatever it is. That's your goal. I define well priced just being about 10% for this channel to give us an idea where we're going. All right, let's dive right into Verizon. Let's take a look at revenue for Verizon. So Verizon's revenue, $120 billion in 2013. Now I've got 9 years of historical financial data here to give us some perspective on Verizon. These are in millions USD. End of the fiscal year for Verizon is December 31st. So December 31st, 2013, those 12-month period of time, $120 billion. They grew revenue extremely weakly to a peak of last year in December 31st, 2021 of $133 billion. When you look at that over time, over those 9 years, that's an average growth rate of 1.3%. Absolutely nothing to write home about. Very weak growth. Now, I will say this last year in 2021, they grew revenue almost 4%, which is the biggest growth they had, and is the lion's share of this long-term growth was in this final year. So I think really this business is a completely mature business, and they're going to grow. This is essentially inflation over this period of time. So I would expect them to have very weak growth going forward, but it does check the box. Technically, it's a positive number. Let's take a look at EBITDA. Now, EBITDA is our enterprise level earnings, right? We don't look at earnings per share because it can be manipulated by the number of shares outstanding. We want a business that can grow its actual earnings. And we look at EBITDA as one example of enterprise level earnings. You can look at operating income. You can look at EBIT. I choose EBITDA. $48 billion to $48 billion. So that is a 1.6% growth rate that's a 0% growth rate if I look year over year. If I average several years here and average several years here and kind of divide the two to give me more of a blended range, I kind of pick up this $36 billion dip, and these 3 years have all been in $48 billion range. So I get a very weak 1.6% annual growth rate of the earnings, which is positive, which is basically in line with revenue. So it can check the box, but really barely. Okay, now let's look at enterprise values. How do we get enterprise value? Well, for any business, you start with the amount of debt that they have. So here we're going to pick up debt. This is short-term and long-term. This is capital leases. This is any obligation that requires an interest payment. It could be secured, it could be unsecured. But it's a debt obligation that is typically some sort of bond or note that has been issued. Could be a capital lease as well. $93 billion in 2013 to $177 billion 9 years later. That's incredible. That's a really whoppingly high number. In fact, if I look over at my one-pager that we distribute for the Cash Flow Club that gives 10 years of history, the year before this number was $51 billion. So in a decade, it went from $51 billion to $177 billion. That's a tripling of the level of debt that they hold over flat earnings. So that's a big concern of mine. Let's see how it plays out. But the first thing we need to do in enterprise value is get debt. So we do this. Next, excess cash. They have none. They used to have some, now they have none. So we're not really going to have to do too much there. Market cap, that's average stock price times the number of shares outstanding. I add the market cap with the debt, less excess cash, and I get enterprise value. Again, enterprise value is the true value of a business. It adds the debt and the equity, much like a house. If you want to know what the house is worth, you add your equity and your mortgage together. That's the market price of the house. So it's gone from $234 billion to $393 billion. Again, earnings have been flat. I guess its market cap has grown 100. What's that, like $80 billion? And so has debt. So it's kind of a blend of both of those growing, combining to show this. If we look at it on a multiple basis, right? So the multiple that the company trades at, the enterprise value divided by EBITDA. Think of it as a payback ratio. The number of years, if I bought the business, that it would take for the business to generate the cash flow to essentially buy itself. It's a payback period. It was averaging in the low single digits, 5, a little pop there at 8, 6. You look at these two, 5, 6. 5-6 times range is very, very cheap. Obviously, because it's not growing very much. But then the last several years, their multiple has increased as the market itself has grown in seeking yield. People are diving into this because it's a dividend stock, and I think that's driving the price higher. It's now at a high end of its range, which is 8 times. So still, as far as a company in this market goes, a single-digit EBITDA multiple is cheap. For this business, it looks like it has a narrow range, maybe 5 to 8 times, which is a very tight range, but it's at the high end of that range. And then lastly, let's take a look at the debt ratio. Now, the debt ratio is very important here. This is us looking at debt less cash, so our net debt, divided by EBITDA, the number of the earnings we make every year. So this is saying how many years of earnings is it going to take for the company to pay off all of its debt? If it had to, we want 3 or less. And you can see in the beginning of the decade, 1.9%, so about 2 times earnings. And it went quickly into the 2s. So you say 2.3, 2.4, 2.6. And then the last couple years, 3.1, 3.7. So the debt has gone from acceptable range for us of 1.9 to above our target at 3.7. I'd like to see them bring this down. When you look at in totality over the last roughly decade, clearly their debt is rising. I think that's because they're trying to do acquisitions that either aren't paying off in cash flow or they're touting a dividend that they've been paying out for a long time, which is stacking up in terms of the debt that they're borrowing to make that dividend payment. Okay, let's go take a look at cash flow. But before we do that, I want to remind you that if you like what you're seeing here, you should definitely check out my website, cashflowinvestingpro.com, where I teach a course on how to value companies. I give you Excel sheets like this, and I show you how to model out, forecast a stock, and I teach you how to build all the stuff behind me. All right, let's go through and look at cash flow. All right, here we are with cash flow. Your favorite statement, my favorite statement, the cash flow statement. Where the rubber meets the road, as I like to see. So the cash flow from operations, CFO, cash flow from operations, that's the first third of the cash flow statement. It's how much actual jack do they make every single year. Income statement has non-cash costs in it, like depreciation, or it can recognize revenue that they actually didn't get paid on. The cash flow statement is pure hard cash that they made in the year. That's why we start here. And what this is saying is they had $38 billion in actual cash flow for the year to $39 billion. That's essentially flat. If I do the same averaging I did for EBITDA, where I'm looking kind of average here, and divide it, I get 1.3%, which is extremely close to the 1.6% of EBITDA. So I will say this, the accounting team is doing a solid job recognizing cash flow on the income statement. I like that, because they're both growing, and they're both growing very close to each other, which is a good smell check for accounting. What I don't like is it is extremely weak in terms of its growth rate, right? In line with EBITDA, but low. The CAPEX, that's the amount of money that they put back in their infrastructure, right? So if they have a cell tower network, if they're rolling out 5G, that costs money to install. This is how much they're putting back. So last year they put $20 billion into the infrastructure, back into the system. Prior to that, they put $18 billion. These are huge, chunky numbers. And it's kind of a moat, actually, that they have the cash flow to do this. They've already built the infrastructure. This is a benefit that they're able to do this and defend their market position. But it also takes away from the cash that they generate every year. So if I look at this, they generated $40 billion of hard cash running their business. They peeled off $20 billion, put back in their business. That leaves about $20 billion for debt service. And if you look back in time, that's about the same last several years, about $20 billion, which is a lot of jack. I will give you that. We'll see how it stacks up for the shareholders themselves and its price. But right now, I would say the cash flow is strong, but growing very, very weakly, because I like this almost 50% rate of CAPEX to cash flow, which leaves a lot of cash out there to pay dividends, buy back stock, do what we want. Let's take a look at their debt. So now I told you earlier that debt is growing, and you can see that here. They borrowed a lot early in this period, spiking the debt. They made some very weak principal payments through this middle period, and they borrowed a lot the last 2 years. Now this last year they made a big acquisition, so that's part of what they're doing is they're trying to grow and buying companies, fine. But in the totality, even after they consolidate the earnings from the new business, they're still left with more debt than they started with, which I think you're seeing here with all of these large, chunky, positive numbers. That is massive inflow to run the business, to do other things with, that is making it a little convoluted to tell by cash flow from equity holders, the sum of these three. This debt, they can't really rely on, or us as equity owners shouldn't rely on it because you can only grow debt so high. So what I'll do going forward is I'm going to take just these two, I'll assume zero movement of debt, and I'll string that forward and see what that looks like. But last year, cash flow technically was $40 billion, 41. That includes 22 of debt. I'll back that out and say $20 billion of cash flow. Shares, 4.1 billion shares. They're growing slightly. They're really not buying back shares. Most all the cash that they do produce is going out as a dividend. They're not buying back shares. On a cash flow per share, again, at the $40 billion mark, that's too high. We're going to adjust that here in a second. Share price and the yield. Now, I said earlier, if you adjust the free cash flow, this 40, by removing this 20, that's what I'm doing over here. I get about a 9% yield. This is me taking cash flow from operations, less CAPEX, divide by the market cap. Currently, for the last several years, if I adjust the cash, I'm in the 8-9% free cash flow yield for this business, which is a very, very strong yield. Now, the current stock price has a 5% dividend yield on it, with cash flow at about 9%. So they're paying more than half of their cash flow out every year as a dividend, and that's a solid commitment that they need to make and does limit its flexibility. So keep that in mind. Now, I summarized all this in a one-pager that I produce at the cashflowinvestingpro.com website. This is the Cash Flow Club, where I give 10 years of historical information, just like you saw here, the forecast for EBITDA and cash flow and an IRR return example for each company, and I rank it. I give you the 5 key attributes. I say, hey, this is a good stock or not in terms of my opinion. You can sign up for this club if you want. I release a lot more stocks in the Cash Flow Club than I can on the weekly YouTube video, so check it out. All right, the forecasting for this business is going to be fairly simple because the business itself isn't growing very much. There's not much room to guess here, and it's kind of like 0 to 2%, someplace in there. I'm gonna, their Q4 results are saying 2 to 3% earnings growth. I'm gonna haircut that back because they just haven't been able to produce that historically. Certainly in the long period of time, I'm not gonna give them credit for it. So I'll keep the 1.5%. I'll say next year, $49 billion of EBITDA. Over a decade at 1.5%, that's gonna grow to $56 billion. I'm gonna give a 7 times earnings multiple on this business. Remember, it was trading between 5 and 8. I think 8's the high end, it's gonna come down. I'll say 7 over time, which gives me just under a $400 billion enterprise value. They're still gonna have debt. They'll have $200 billion of debt, which in my opinion is still too much. So I peel that off and I only get a $188 billion market cap. Divide that by the same shares outstanding, 4.1 billion, I get a $45 price target for Verizon out 10 years. Okay, let's forecast cash flow per share. So what I'm doing here, $4.94 next year target of free cash flow equity. Now again, that's just cash flow from operations minus CAPEX divided by the number of shares outstanding, and I grew it at 1.5%. Assuming that debt stays the same, that they don't pay it down too much, they don't increase it, and I stretch that out in the future and I get 5.65% out in the long term, and I give a very healthy 7% yield to that free cash flow over time, and I get an $80 price target for Verizon out 10 years. Okay, now we have 2 price targets. We have one based on a free cash flow method, $80.75, and we have a second based on an EBITDA market multiple method, $45.48. I'm going to weight these 50-50 because, who knows, kind of split the difference a little bit. And roughly a $63 price target for the stock out 10 years. Now we look into the stock market and we see what it's trading at. You never want to look at the stock price before you render your analysis. Come up with your analysis, be unbiased in your forecasting, then go look and see what the market is trading at, because the market can be very, very inefficient and you want to have your own lens on what you're going to pay for the business. So I think it's 63 bucks. I look out in the market, whoa, surprise, surprise, I can buy as much stock as I want at $53 a share. So it's basically a $10 growth rate over a 10-year period of time. Let's see what that does with an IRR calculation. All right, so here's our IRR calculation, right? That's the internal rate of return we're gonna make on our funds, assuming all this happens out over 10 years. And what you're gonna see is strong cash flows every single year, right? Because they pay out, they have good, strong cash flow. And we're assuming that they're gonna pay it all out or buy back shares or whatnot. I can buy the stock right now at 53 bucks, and I can sell it in 10 years at our estimate of $63. This is my net cash flow, and that yields a 13% IRR on this investment if I hold it for 10 years, mostly driven by this strong cash flow. A lot of it's represented in a dividend out to you. There's obviously taxes that's not in here, but it's predominantly cash flow generation, not capital appreciation that's driving this IRR. So is 13% a good IRR? Let's take a look at a distribution chart for us and figure out what we'd be willing to pay for the stock over time. Current stock price, $53, 13% IRR for this stock. If the stock were to go up higher, it gets in the single digits really quickly, and I'm definitely not a buyer of it. If it falls, I start liking it more and more. All right, now how do we decide what we want to do with this stock? Let's review our 5 key attributes for Verizon. Number 1, top line revenue growth. Yes, it's growing. Very, very weakly, but it's there. Number 2, EBITDA growth. EBITDA is growing. I'll check that box. Number 3, strong cash flow. Yes, they have strong cash flow. Number 4, debt. I think the debt's too high. For me, I'm a pass. And a well-priced, I'm going to pass as well. I think no. So overall, I'm going to give it a meh. there's a lot I like here. I like the strong cash flow. I like the contracts they have with the customers. What I don't like is the debt's been growing up and over the last decade. And I think the price itself is on the cusp of being attractive. But for me, given the level of debt, given where we are in the economic cycle and the chance of having a significant market pullback, I want to keep some cash. And so I'm going to take my IRR thresholds and I'm going to say things have to be a lot higher for me to go into this market at this point. Or I can sit in the sidelines and make hopefully get a better deal. What I did want to show you is we are facing rising interest rates, and I wanted to just make you aware of something. So their debt right now is $177 billion. Now, most all corporate debt is variable rate debt. The feds are raising interest rates. The European markets just went up as well. So what I want to show you is that every 1% in interest rate moves is $1.79 billion of cash flow that's going to come out of the income statement, cash flow, and the P&L of Verizon because of how much debt they have. Now, Fed's funds rate is currently still zero. They're trying to target a 2% rate. 2% on that money is $3.5 billion a year. How much cash flow did we say that Verizon itself generates? CFO minus CAPEX, these two was $20 billion. Yes, that's $20 billion. If interest rates go up 2%, then they are going to lose 18% of their free cash flow, the cash money that they use to pay stock dividends and so forth. So I think that for me is a risk. I think it's a risk in the capital markets right now. So I would definitely make sure your portfolio has as little debt as possible in it. All right. If you liked what you saw here, if you liked how I reviewed financials, if you liked how I built a forecast, looked at an IRR, I teach a course at cashflowinvestingpro.com. The course is going to walk you through how to read a 10K, how to pull out the revenue, EBITDA, cash flow, how to calculate fully diluted shares outstanding, how to build a forecast. I will give you this Excel template and walk you through how to value a stock that you choose for your own portfolio, right? There's more than 3,000 stocks in the public market in the United States. Analysts can't possibly value all of them. You can learn how to value them yourself and position yourself for the future. So definitely check out cashflowinvestingpro.com or sign up for the Cash Flow Club and get monthly reports on stocks with a cash flow lens. Thank you very much for watching the Rational Investing video. Up is going to pop a couple other videos. If you like them, click on one of the links and watch some more reviews of other cash flowing stocks. Again, like, subscribe, comment if you like the content. I greatly appreciate it. Throw a comment down below. Let me know what stock you want to see next. I love looking at stocks. Verizon was a lot of fun to do. Really, really appreciate the time. Thank you very much for all the energy, the support, and all the cash flow members out there. We're growing. We're doing really well. Thank you very much. We'll see you next week. Bye-bye.